Hey, welcome to the podcast, everybody. Thank you for joining me. Hope you had a great weekend. The stock market is closed, and you can see from the screen what happened today, which was a kind of a methodical rally. It wasn't real intense, but everything participated, as you can see, pretty much everything. Utilities here down on the day. We'll get to that in just a minute, but the Dow Jones Industrials finished at 13,239, 13 up 6.5 points, and S&P 500 up over 1,400 still to 14, almost 1410, up 5.5 points. And as we go through all the different sectors here, you can see pretty much technology still leading the way, but financials were strong as well, especially bank stocks. And you can see the Russell 2000 actually outperformed today, which is what a lot of skeptical bulls are looking for, is do transports continue to come back? Does the Russell 2000 lead? You want to see that those types of things not have negative divergences. And what we've been getting from a positive standpoint is we've been getting obviously oil fell the day that the Strategic Petroleum Reserve news came out. Transports took off. Oil went back up on Friday. They didn't really give it back, but you've been seeing that. Plus the Russell 2000, they would like to see that heading back up. Now we've been seeing semiconductors participate, financials participate. So again, everything is participating. We don't have a lot of volume, but again, there's been plenty of time since 2009 that we haven't had a lot of volume. It's just getting so low. It's quite amazing to watch, actually. Now, we talked about utilities being down today, and they've been noticeably weaker the last few days. But remember, interest rates have been going up the last few days. And you may say, well, what does that have to do with anything? Well, this picture that I've got on the screen, this is the correlation between utility stocks and interest rates. And it's inverted. So when interest rates are going up, utilities have been coming down. And that's been more pronounced really since last summer when everything started to get real volatile. Of course, interest rates were coming down at that point. People going to bonds. People were getting out of stocks. But the correlation now you can see is almost getting closer to a -1. So on a day where interest rates are up, utilities are down. So if you're somebody that thinks rates are going to continue higher and this is it, this is the turning point, then you need to exit utilities. I'm not so convinced, so I'm not selling my utilities. I've had utilities a long time. I still like them. I think in an economy that's fairly lethargic like we have, that utilities are still going to work, and a lot of them are still yielding, very nice amounts. I mean, even the basket, the XLU, the utilities ETF basket, I think has over a 4% dividend yield. But this is why you're seeing utilities struggle on days where interest rates are going up. They sometimes are treated as a bond. Very stable companies. And when interest rates go up, of course, bond prices come down, and you also see utility stocks come down. It's the same thing with preferred stocks. You'll see that as well. They're treated almost like a bond in the sense that they have more of a fixed income. And when interest rates rise, those things tend to drop in price. Big news of the day, Apple, of course. What else, right? You got something that is defying gravity here. And as I mentioned a few podcasts ago, I sold out. And I'm being penalized for it now because Apple continues higher. I had well over 100% profit in it. Thought I was Mr. Smart Guy and that I could probably buy it back cheaper. And it continues to go up even after I sold it. So, but look, the stock is going parabolic. This is a chart. I don't care who the company is. I'm not going to buy this chart. And it's painful not to buy it when it continues to make new highs. But I'm not going to buy it right now. It's gone vertical. It's overbought by several metrics, not from a fundamental standpoint. That is important. And the fundamentals in this case have trumped the technicals. The technicals have looked like the stock was ready for a pullback several times, and it just continues to go up. But they announced, in case you were on another planet, they are going to use some of that $100 billion of cash. They're going to basically take $10 billion of it. They're going to pay out a dividend and buy some of their stock back. Now, the stock, was up $15 today, just over $601, but still not a huge reaction. You can see the volume here, not as big as you would think for something like this, and that was, I guess, fairly well anticipated they would do something like a dividend. Now, the dividend is going to be $2.65 per quarter, which comes out to about 1.76%. So it's still under 2%, and they're going to do a stock buyback. But they're still, now you saying, okay, it's going to get them down to $90 billion. But remember, more cash keeps coming in, so they're going to be up over $100 billion again. So this is probably the first step, and it appeases some of the large institutional owners that have been begging for a dividend and really felt like it was reckless not to do something with that cash. Those people are getting appeased. At the end of the day, again, I'd rather see them do something more strategic with it, buy another company. But you know what? I'm not going to question them. I'm a lifelong Spurs fan, and whenever the Spurs make a trade or they cut a player or they sign a player, my brother and I always talk, and the last thing I always tell him is, hey, in Pop we trust. Greg Popovich, the head coach, he's been the head coach here since, I believe, 94. We have 4 rings. So whatever he thinks is best, I'm going to trust him at the end of the day. Does he make some dumb decision? Sure. He's human. But at the end of the day, in Pop we trust. That's what I always tell him. And my brother always laughs. It's in Apple we trust, right? Yes, Steve Jobs isn't around anymore, unfortunately. But all his ideas are, his culture, what he wanted is still being continued on. And look, I'm not going to question what they're doing here. It's not a huge thing. It's almost a token gift, really, to these institutional shareholders, and it allows people that only buy dividend stocks to go out and buy the stock now. Mutual funds have a very specific idea on what types of stocks they want to own or can own. It opens it up to a lot more companies. Now, is it considered a value stock because it pays a dividend? It's got a low PE? Maybe. So it may have some more pent-up demand, believe it or not. But I'm still looking to get back in. And am I trying to get back in lower than I sold it originally? Yeah. Is that likely to happen? It may not happen. And the thing is, if Apple does start turning around and heading south, we have to realize there's probably big issues in the market because it's so heavily weighted now. So if Apple goes down, you could see the whole NASDAQ go down, NASDAQ 100, and that could spill over to other areas. But technically, if you want to add a 10-day moving average or something to help you get out, fine. If you own it, you want to take some off the table, perhaps selling some. But I'm not buying it. Yes, I'm frustrated. I'm not in it right now. Nobody's ever complained about taking 100% profits. But hey, let me tell you something. That's how you know you're in something very strong, when you take big profits and you're penalized for selling it. And that's very similar to the market right now. You're penalized. Most of the trades I've made have been selling things, locking in profits, and then they move higher. And that's a strong stock market. And I think that's what we're dealing with right now. So we'll get to the stock market in just a minute. But one of the things that's causing the market to go up, or it could be the cart before the horse, who knows? But interest rates have spiked up, and you know this by now. TBF. A lot of people know about TBT, which is a double short treasury. This is a TBF, which is just the regular short. And TBF has obviously popped like everything else. It's short treasury, so as interest rates go up, you make money on this. Now, the thing is, it had been kind of building this base, and it broke out the other day, of course, and obviously had been banging up against here. The 50-day moving average has turned up, went up on very, very heavy volume, and we broke out, gapped up, and hasn't really given it back. Had a couple of down days, but nothing major. And then today turned around, had another nice day. Didn't finish at its highs, but a pullback somewhere in this area would be, and then a bounce off of that would be the place to buy this. Now you have to look at this and say, what if I was to buy it right now? I've drawn this line to the last high, which is about $35. We're already sitting at $33.91. So $1.10 upside potentially. You're almost kind of in the middle. So I'm not doing anything yet with interest rates. I did sell something that was more interest rate sensitive last week when this popped. So something that would get hurt. I owned something that was heavily invested in treasuries, and so it had been making decent money. But when it rolled over because rates had popped up, I decided to get out of that. So I haven't taken the next step of shorting treasuries, but because, again, economically, I'm not sure that things are as rosy as people believe, but this is either money coming out of bonds to fund stocks, or it's people believing the economy is better, whatever the case. So is it the beginning of the end of the long-term downward trend in interest rates? I don't think so. I mean, when we zoom out here and you see how far this has come, we've had these rallies before where we've popped up and then faded, and now we're popping up it is the 50-day moving average is obviously going in the right direction, but the long-term picture of interest rates, we're still just now getting back into the downward trend. So I don't know if it's necessarily in. You would have to see, I think, a vibrant economy, and we simply don't have that. At best, we have a mediocre economy. At worst, we may be in a recession right now. And I was one calling for a recession. I may be wrong about that. Who knows? But I certainly am not going to flip and say that things are great. I think at best, we're in a lethargic economy that may grow a little bit, but we still have people leaving the workforce. We obviously know the unemployment rate's coming down. The participation rate of employment is coming down as well. A lot of regulation. We've got a lot of uncertainties coming up with not only the election, but you got the dividend tax could be tripled. You've got, how do you estate plan? How do you tax plan? All these different things. And I think a lot of the earnings being pretty good so far have been because of inventory buildup. So let's see. I mean, again, there's a lot of people out there that are still calling for a recession and still saying things are awful. I don't know if they're awful or they're just not good, but they're certainly not great. And the market has been going up based on it being great. Now, that's the fundamental side. That's the little guy on my left shoulder that is saying, you know what, things are horrible. You shouldn't own a stock at all. There's also the guy on the right shoulder that says, you know what, your job is to make money. Leave the economic speak to the economists. But when you're investing, you have to take in consideration the economy, the fundamentals. But there's another important part, and this is the part that a lot of people miss because they may be right in looking at some of these different metrics. There's a lot of perma-bear, economists that have been bearish since 2000. They've missed several rallies, and I think a lot of them are missing out on this rally. But when the technical side of things are improving. It's not getting worse as the market's going up. It's actually getting better. That's very important to distinguish. Now, somebody emailed me the other day and said, hey, thank you for warning us about 07 and 08 because 08 was a horrible year, obviously, and you were telling us that things were not looking so great in 07. And I said, that's true, but there's a big difference between now and 2007. In 2007, what you were seeing was several stocks had made tops in 07 and were heading down in 07. The economy was clearly weakening. You had different sectors not participating. You had the number of stocks going up versus down weakening. You had upside and downside volume weakening up. All these negative divergences in 2007. So the market was going up, but everything else underneath the hood was getting worse. We started to see that in July and August last year, right? And the market went down. But now what we're seeing is all those different metrics are actually very close to highs, if not making new highs. And remember, the breadth is spreading out. Financials participating, semiconductors participating. So I think technically things are getting better, not worse, which makes me want to buy stocks. And I am. I'm averaging in over time. With the cash I have, you don't go and dump it in. You wait for opportunities. The only opportunity we've really had is a 200-point sell-off one day, and that was erased the next 2 or 3 days. So you haven't had much opportunity. You can see it on the picture here. The 200-point down drop, that was on March 6th, and in 2 days it came back, and we're going higher now. So this is the spiders, by the way, the proxy for the S&P 500. But in the very short run, you don't run out and just buy everything. So there's charts that are still looking good, but we are very overbought in the short term, and so I expect the next day or two, and potentially into the end of the quarter because of the window dressing, for the market to be pretty good. But then I think we'll get a pullback, and that may be an opportunity to buy at that point. But again, it's a fluid situation. It's fluid with tension in the Middle East, oil prices, the consumer. It's fluid with earnings, Greece, Spain, Italy. All those things can change on a dime, and this market volatility could pick up very quickly. So while I'm participating more and more the last few weeks, I'm still in a more conservative mode than maybe a lot of people out there, and certainly somebody that's 100% in stocks. I'm not near 100% in stocks, but I'm trying to find the things that are working. I'm still taking profits in areas where things have gone up too far, too fast. And I think a portion of what you should be doing is looking for income. A portion of what you should be doing is looking for trades, short-term trades, and a part of what you should be doing is looking for things that are just good, plain investments, really in any environment. And I think if you put those together, you'll sleep better at night. You won't have to worry about, is this the top? Is this the bottom? And you'll make decent money. And again, right now, when a market's going straight up like it is, it's very hard to make money unless you just throw it all in there. I mean, if you're somebody that's kind of mixing it up, you're not getting rewarded for doing your homework, right? Because going and buying an S&P 500 fund works pretty well right now. But we both know that that's not going to continue forever. We could easily get back to what we saw in the fall of last year. And that's not necessarily to say we're going to have 400-point up and down days, but we could, and you better prepare for them. But I also know it's not going to be a consistent thing where we have the volatility extremely low and the market goes up 30 or 40 points every day and everything's great. So average in, take advantage of it right now. But certainly if you've got too much cash, don't go overboard with it. Now I want to show you this volatility. I just talked about volatility. I want to show you. I had this picture up on a blog earlier last week, I believe, when the VIX dropped below 15. There was a lot of comments that, hey, it's below 15, watch out below. And I think what people were looking at and what I saw on the report that I saw was they were focusing just from 2008 until now. And yes, every time we've been at 15, the market has had pretty good sell-offs. And so they're saying, hey, watch out, we're going to have a sell-off. Well, I actually want to look at this from a longer-term perspective. And when we go back to 2002, 2003, the area I want to focus in on is right in here, 2004, 2005, 2006, because we spent a lot of time with the VIX below 15. Now, you could say, hey, yeah, Carl, but we didn't have high-frequency trading back then. There's a lot of different things going on back then. And that's certainly true. I'm not arguing that. But I just want to point out that look what the stock market did during that time. The stock market just slowly drifted higher, little corrections here and there, just drifted higher. And remember, after the initial pop in 03, which was a recovery year, remember we had 2000 through 2002 was horrible, and then 03 was a recovery year. 04 was very mediocre. 05 was okay. 06 we had a summer sell-off. But we were going higher, and it was a pretty nice time. It wasn't great, but it was a nice time to make money, and it was a more calm stock market. Could we be going through that now? It's possible, and I just want to open your mind to say, hey, you know what, Carl, maybe we are in a lower volatility environment. Who knows? So, again, I present you the entire picture of a low volatility environment and a high volatility environment, but I'm not just going to give you half the story and say, hey, the VIX is below 15, surely this market's got to come cratering down. I think that it's possible that we could still be in a high volatility, and I expect more volatility in the next few months, especially closer to the election. But I just want to prepare you that this has happened before where the volatility stayed within the low teens and the market just drifted higher. So just take that for what it's worth. But if you're wanting to play the volatility, again, it is getting cheap even from a short-term perspective. So if you're averaging in, dollar cost averaging into some type of volatility tool to benefit from higher volatility, it's probably going to pop at some point soon. You're getting a pop in the RSI. You're getting this positive divergence, whereas the market's still going down. So it's something I'll look for. But the positive divergence has been there for a few weeks, and the VIX continues to fall. Now, this is the VXX ETF, which is probably not the best way to play this. There's all types of problems. I've pointed that out many times before in podcasts and articles that the volatility index played through the VXX does not hold the longer it is. So if you expect the VIX to pop over the next week or two or three, playing the VXX is fine. But if you're playing for it to pop in the next 6 to 9 months, then you're going to have to do it another way using futures and so forth or options or whatever the case. But VXX is just it's got the same problem that some of the double beta inverse ETFs have, where the longer time goes on, the correlation just breaks down. So keep that in mind. But for those people that are playing the VIX, again, long-term move could be right in the next few months if you want to play it that way. But again, let's prepare and be prepared for what if we're just in a low VIX environment. What happens then? Well, the stock market would likely continue up, and the sell-offs would be much more mild. So, hey, by the way, I wanted to mention I did get the new Apple TV. Now, for those that don't know what this is, it's not an actual TV, although that will be coming at some point, probably within a year, voice activated using Siri, etc. But I got the Apple TV, which is about the size of a hockey puck and a little bit bigger. Has an HDMI cable, so it goes from the hockey puck to the TV. And then there's an audio cable. You do need an audio cable, a fiber optic cable that goes from that to your receiver. And then you plug it in, and it picks up wirelessly your Apple computer iTunes, which I have an iMac, and which I use for home. And that iMac has iTunes on it, and whatever movies I have, it pops up on the TV with a nice menu, or you can obviously rent or buy movies on it. It also can play your music collection, your pictures. And here's the other thing about it. It will play all your podcasts. So if you see my podcast, and it's got a podcast channel right on the screen there, so you go to podcast, you go over and search Carl Eggers, and you'll see all my podcasts pop up, and you can watch it on your 61-inch big old TV, which is kind of cool. I haven't put it in high def or anything like that, but this new one does do high definition movies and so forth. But so for podcasts, it works great. It's really cool. And or if you have the podcast already set up in your iTunes, it'll play straight from there. So you can go search for the podcast, or because they have a podcast channel, or you can go right up to your iTunes and hook up that way. But cool little device, $99. But eventually, yeah, they're going to have an actual Apple TV. They may partner up with somebody like Samsung, have a TV, and I envision using the Siri on there where you would say something like, Siri, show me the all the college basketball games on, and it'll pop up. Here's 8 college games on. Show me the Kansas game. Show me the North Carolina game, Syracuse game, or record it. Something like that. I think voice activated. That is coming. There's no question. That's the next big thing from Apple is an actual TV. And remember, they're pricing this stuff. You can see on the screen, $99 for an Apple TV is pretty cheap for this wireless unit. Plus, it does hold, it holds movies on there as well. But the thing is, the reason it's cheap is because they want you to order the content. That's where they make the money. They don't necessarily make it just from this device, although I'm sure it's profitable. They're not giving it away, but still, they want you to buy all the content, so they're making it easier and easier for you to get content. The easier it is for you to get it, the more likely you are to buy it. And so fundamentally, Apple's still going gangbusters. I have, through my years, bought an iPod, 2 iPod Shuffles, 2 iPhones, an iMac, let's see what else, an iPad, and now an Apple TV. So I have a lot of Apple products. But so I'm a good customer, and if you own the stock, you're welcome. All right, guys, have a wonderful day. Thanks for checking me out. CarlEggers.com, Twitter.com/Carl Eggers, EggersCapital.com, Google+, plus Carl Eggers. We're on there as well. Thanks. Have a good evening.